G'day guys, today we speak to Jamie, the founder of Senjin Capital, a Japanese equities fund manager. We cover a lot of topics related to investing in Japan. Jamie's a real pro. I do hope you enjoy it. As always, please give me feedback. Thank you.
So we're recording. Thank you, Jamie. So just a little bit of background before we dig in. I've obviously had quite a lot of experience with Japan, and I write a lot about it in my newsletter. Those newsletters tend to be the most popular ones, the ones about Japan. And I was asked to get a Japan specialist on the podcast, and I'm very pleased to say that we were able to get you on, and it's a pleasure to have you, Jamie. So I think, Jamie, to start off with, let's hear about you. Where were you, where were you born? How did you get started? Give us some history.
Thanks for having me on, Martin. I'm originally from New Zealand, so I grew up in Auckland and have had a long association with Japan ever since my father suggested that I should study a bit of Japanese because Japan was New Zealand's, I think, biggest trading partner other than Australia at the time. And so studied some Japanese through high school, did a trip and did a homestay in Japan when I was 14, which gave me some really great insight into the culture and a lifetime, sort of set off a really a lifetime connection with the place.
And where was that, Jamie? Was that in Tokyo, or was it somewhere?
No, it was out in the countryside, relatively speaking. But to me, coming from we live semi-rural just outside of Auckland, Takasaki, where we visited, which is about an hour, 50 minutes north of Tokyo on the Shinkansen. That felt like a big city.
Sure.
But where my host family was living was, by Japanese standards, quite rural. That was a great experience. I actually got to visit them again actually last weekend on a recent trip to Tokyo. So I saw them for the first time in 27 years.
Wow.
Which was great.
Wow. Yeah, brilliant.
So we had an affinity with Japan from that, and visited again when I had a friend teaching English over there on the JET program. And then I moved to Australia in 2008 for a job on the buy side in finance, originally with CP2, which is primarily an infrastructure fund, also did some Australian equities. And that did both public and private deals. So I got to look at both public and private transactions, whereas a lot of people in the industry, they're either private markets or public markets. So that was really good formative experience. Baptism of fire starting just before the GFC, but I think I was quite lucky to get into the industry before that happened.
Sure.
My background was a bit atypical. I studied law at university, but taught myself investing just by reading a ton of books, and taught myself corporate finance essentially, and was able to transition across. So after a few years there at CP2, I joined Platinum Asset Management, which at the time managed about 25 billion in global equities. And had always, ever since Japan became a value market, Platinum had was overweight essentially Japan. And so we spent a lot more time on Japan than the average global equity manager. And Platinum had actually established a Japan specific strategy back in the late 90s, which has a very, very strong long-term track record of outperformance of the Japanese market.
Yep.
And I was appointed to run those strategies from 2021. I'd already been running a global strategy for 4 years at that point, but basically ran that Japan strategy from 2021 through to March this year when I finished up with Platinum. And now I'm in the process of launching my own fund, which is activist, we say constructive engagement fund, looking to work with Japanese companies to help them create shareholder value, essentially.
Great. So Platinum, for the international listeners, a Platinum is an Australian-based investment fund. Is that correct?
Global equities focus.
Yeah.
Their flagship is the Platinum International Fund.
Yeah.
And had a very, very strong track record since inception. The last sort of 10, 15 years have been a bit more difficult with what's happened with US tech leadership, because Platinum's generally more focused on valuation. And it's been a tough time for value managers, particularly in global markets, and particularly if you're underexposed to the US.
And so generally a good place to cut your teeth, especially in Japanese equities, right?
Oh, yeah, definitely. I came up under Ken Nielsen,
Yeah.
as well as Jacob Mitchell, who now runs Antipodes, and Andrew Clifford, who took over running Platinum after Care stepped back.
Yeah, brilliant. So before we get to your strategy and your fund, I think just for the general listener, obviously they've heard that Japanese equities are interesting, but sometimes it's hard to put this all into context. So I think it might help just to describe what has happened way back since the bubble burst in 1989. And if you could sort of summarize some of the key developments before we dig into what's happening now, that would be great. That's okay.
Yeah, so if you think about Japan post-war, they had this economic miracle. It was boosted by the Korean War and the Vietnam War. Japan really benefited from that, and that really set off their economy. And then you had these super innovative companies doing really interesting things like Sony with the development of the transistor radio. And Japan became really big in the whole chip space, microchip space. This triggered essentially this idea that the country was just going to keep growing. And they started borrowing, buying real estate. And you got to the point where at one stage, the land under the Imperial Palace in Tokyo was valued more highly than all of the land in California, which is clearly just this insane bubble.
Yep.
So we get to 1989, that bubble pops, and a ton of companies are teetering on the verge of bankruptcy for the next 5-10 years. The banking system's full of bad loans. The government tried to force the banks to restructure over time, but they just needed time to actually work through the problem. Otherwise, the entire banking system would basically have been bankrupt.
Yeah.
So in the late 90s, you had the government basically push the banks to sell off a lot of their cross-shareholdings. And that's the first time that we really see the cross-shareholdings in the market really tick down. So the whole Japanese system had been based around this idea of interlocking networks of shareholdings, which stopped takeover activity happening in the market, protected managements, allowed them to invest for the long term and grow without needing to focus on short-term results. That's all well and good when you have a growing market and you have a growing population and you're doing well. But then Japan started to face competition from Korea, Taiwan, and then China, and really undercut them in a lot of areas. And so they had to start to outsource to be cost competitive. You saw the domestic manufacturing base essentially be hollowed out, similar to what we've seen in Australia and the US.
Yep.
And so the government, like you basically had a couple of lost decades. Companies didn't want to invest because they'd been scarred by what had happened previously. They definitely didn't want to borrow. They hoarded assets. So you ended up with these balance sheets that just look crazy, massive amounts of cash. Companies were starved of ideas for investing in actual productive assets. So they started to buy real estate with their excess cash. And so you ended up with a situation where companies would regularly be trading at market values well below the value of the easily saleable assets on their balance sheet.
Right.
And the economy stagnated. And so 2011, Shinzo Abe was elected prime minister. Well, his party was elected with him as the leader. And he instituted what later became known as Abenomics, a series of reforms. First was the Bank of Japan policy to undertake massive quantitative easing to cause the yen to depreciate and make Japan more competitive.
Yep.
But the third arrow of his strategy was probably what was most interesting from our perspective of investing in Japan. Is it was all about corporate governance reforms.
Yeah.
So historically, company managements in Japan have not cared about shareholders at all. They haven't needed to raise equity capital. Capital came from the banking system. They were protected by these cross shareholdings, so they didn't have to worry about being kicked out at an AGM. And the domestic asset managers, which are owned by domestic banks typically, always voted with management.
So in some way, I think for listeners, what I find interesting is this was actually a feature of the US economy before in the 1970s. So perhaps you could refer to it as stakeholder capitalism, I guess, rather than shareholder capitalism. And so it might sound bizarre in today's world that stuff was happening, but there is some context even within the West. Corporates didn't have independent directors, the boards didn't have independent directors. The institutional investors were not necessarily that aggressive back in the US during the 60s and 70s. And then everything started to change, say from the early 1980s. And so is it right to think that with Abe, that's the pivotal point over the last 20, 30 years where things really started to change and meaningful reforms took place? Is that how someone should think it through?
I would say that's the starting point. But
that's the starting point.
For people that closely watch Japan, the change was painfully slow from that point. There was a lot of promise, a lot of excitement, but those reforms are what has created the environment we see now, which is where things are actually really changing really quickly. But it took a long time to get here. It's 10 years before you really started to see things accelerate, and now we're really starting to see that acceleration go vertical.
So before Abe, you mentioned cross shareholdings. I think by the early 2000s, they had already been reduced to a certain extent. And that's when you had the initial rise of activist investors coming to Japan. But they weren't welcome necessarily. Is that fair? No. Yeah.
That's a very fair statement.
Yeah.
So you had a few people come in from overseas trying to buy out Japanese companies. So Steel Partners, there's a famous legal case in Japan, Steel Partners versus Bulldog Sauce, where Steel Partners tried to take over the company in a hostile manner. The company instituted a poison pill. Steel Partners took the company to court to dispute the validity of the poison pill, and the court basically held that the poison pill could stand.
And that's an interesting thing. So, Jamie, on the poison pill, can you first just briefly explain what it is for everyone? And then, is that okay?
Yeah, sure. So, poison pill, it's a commonly used takeover defense tactic in the US and was adopted quite widely in Japan in that mid-2000s period as a defense against hostile acquisitions. So what a poison pill is it allows company board of directors to issue a lot of stock to shareholders other than the company that's trying to acquire them, or the fund that's trying to acquire them, basically diluting the fund's holding so that they can't gain control.
Yeah, so that's true. And that's what I think the poison pill, I think the legislation, it came into law maybe mid-2000s. And for me, who was there, you'd see this happen and you'd go, oh, this is going in the wrong direction, and so I think from a potential investor's point of view, this is why it's so significant what Abe. So there was all these forces that were going in the wrong direction, if you believe in shareholder capitalism, and then Abe-san turns up. And then is it possible for you to explain just some of the reforms that took place during the 2010s? What are the key ones?
Yeah, so the reform program was essentially driven by the bureaucracy, the financial services agency that sits under the Ministry of Finance. And so the first key reform was the publication of a stewardship code in 2014. And the stewardship code sets out how asset managers should engage with companies to try and get them to focus more on shareholders, basically. It also requires signatories to have voting policies for AGMs and to disclose how they vote. And most of the domestic asset managers, if not maybe all of them, have signed up to that stewardship code now. So whereas before, the domestic asset managers would vote in line with the interests of their parent bank and its clients, i.e. the corporates that the asset managers owned. So they were a sure thing for management. They were a sure vote. Now they actually vote a lot more economically. And so that really opens up the market if shareholders are seeking to hold management accountable. So that was the first major reform. The following year, we had the Corporate Governance Code.
Yeah.
And that's a comply or explain. So it's not, none of these things are the force of law, but if you sign up to the Stewardship Code, then you're bound by it. The Corporate Governance Code is comply or explain. But if a company doesn't comply and explains, that provides a really effective tool for shareholders to point to and say, hey, this is best practice. You should be doing it this way. Why are you not doing it this way? And that kind of public understanding of what you should be doing is a very powerful tool in Japan, because there's a lot of pressure on conformity. So you need to be seen to be doing the right thing. So that code came in. Then we had some publications come through from the Ministry of Economy, Trade and Industry as well. So they published some fair M&A guidelines back in 2019. They also published business portfolio transformation guidelines, because Japanese companies have tended to diversify. They haven't focused on their core businesses and growing those businesses. They just pursued scale, even if it's more economies of scope than scale. They just invest in a bunch of different things, whether those businesses are subscale, loss-making, and they don't exit. They've tended not to exit those underperforming business lines. So METI's trying to push companies to think about doing that more as well. And then most recently, a publication from the Ministry of Economy, Trade and Industry came out around takeovers, their takeover guidelines. And at the time, I think most market participants, and definitely I, just sort of looked at that and thought, okay, this is interesting. It's another one of these bureaucratic pronouncements, not binding on anyone. But it's turned out to be a real tipping point. So what those guidelines say, and I published an op-ed recently in the Nikkei Asia outlining some of this. The guidelines say that if you receive a bona fide takeover approach, that you should constitute a committee of your independent directors to seriously consider whether that approach will best enhance corporate value. And while historically in Japan, corporate value's been defined very nebulously because of the whole idea of stakeholder capitalism, boards would think about corporate value from a sense of, does it serve customers' interests? Does it serve our suppliers' interests? Does it benefit society as a whole? And shareholders were somewhere down the bottom of that list of stakeholders. But these guidelines basically instruct boards to consider shareholders' interests, and they also define corporate value as the sum of the present values of the company's future cash flows. So basically, if this takeover would help the company make more money, then it enhances corporate value. And so there's been this real tipping point now where you've seen even like Alimentation Couche-Tard, which is the big Canadian gas station owner, convenience store retailer. They've come in and made an offer to buy 7 & I, which is the parent of the 7-Eleven convenience store chain, which is Japan's leading convenience store chain, and owns a bunch of businesses through the US and elsewhere.
So
the board of 7 & I actually announced that deal to the market, whereas historically, if a foreign company approached a Japanese company, the Japanese company would just say, no thanks, and the shareholders would never know. They're taking it really seriously now. It's a real change.
The moment's come. So early 2000s, you had ambitious activist funds who turned up hoping that you could get some change in corporate governance. It didn't really happen. It required the government from 2011 to effectively establish a set of norms and standards for people to comply with. And that's very typical in Japanese history, because I think there's always been this administrative guidance approach where it's kind of top down. So we kind of had that complete focus from the Japanese government all of a sudden on this issue, or the ministries. And that's what's been so effective. But is it right to say that perhaps the guys who got into the market just after Abe came to power and obviously the Nikkei went, they were just a little bit too optimistic about how long some reforms take? Naturally, they've taken time to come through, and now we're at this crucial moment. Is that fair, Jamie, to people?
Yeah, I think that is reasonably fair.
Yeah.
It's what we've seen since that time is this gradual decrease in the cross shareholdings. So I should step back a little bit. Shareholders in Japan have a ton of legal rights. Shareholders in Japan have much more in terms of legal rights than shareholders in Australia, shareholders in the US, shareholders in the UK.
Wow.
You can file a shareholder proposal at the AGM, basically instructing the company to do almost anything, as long as you get a majority or, in some cases, a supermajority. So you can't really do that here. The issue has always been the cross shareholdings. So you might have the rights, but can you actually exercise them in effect? And so what a key focus of the Financial Services Agency has been to get companies to sell down their cross shareholdings so that more of the shareholder register is open for actual effective voting. And we've seen that happen over time. And as that's come down, we've seen the amount of interest from international investors go up, and the effectiveness of activist tactics increase. So I first started seeing headlines about activism in Japan back in 2016.
Yeah.
But I've been looking at Japan for 4 or 5 years, but I hadn't gone deep down this kind of corporate governance angle. And I started seeing these headlines, and they conflicted with everything I knew about Japan. Because from my sense, Japan was this country where management didn't listen to shareholders. They didn't care about returns on capital. That was why companies were cheap. You could find some good companies in there that were doing sensible things that you could still make good returns from. But on the whole, the fact that activists were there, it didn't make sense to me. So I thought, well, they must be seeing something I'm not. And so I went deep down this rabbit hole, the history of activism, the actual legal environment for corporate governance, looking at Abe's reforms and what the change was. And I just saw this great opportunity from that point. And it's turned out to be that way. So there's about 7 activist funds active in the market at the time on a continuum spectrum from super friendly to super hostile. Now there's about 80.
80. Wow.
So capital's flowed into the sector. They've seen the opportunity.
Yeah. And it's kind of a global thing, isn't it? Activism has boomed everywhere, I think, even in the US and South Korea. But Japan, I always see like the TSC as actually the biggest activist in the world in a way. Even though they're not doing the investment, they want change, right? And so that's why Japan sort of stands out to me. I suppose it might be the same in South Korea. I'm just not familiar with the market. And so recently you've had some big news flow around M&A, right? So going back to Seven and I mean, that was a big offer from the Canadian company, correct? So
it's a very big potential deal, yeah.
Yeah, and so where are we with that? Could you just update the listener in terms of where we got to?
Yeah, so Couche-Tard offered to buy the company. The company put together a committee of its independent directors to consider the deal.
Yeah.
And it seems like, from what's happened since then, it seems like they were very seriously considering that deal. Because what's happened since then is the founding family, which still owns about 8% and has an executive director on the board, they've put together their own management buyout proposal, funded partly by the trading company Itochu and also a consortium of Japanese mega banks. And while exact details of the various proposals haven't been released yet, there's been some numbers that have come out of the Nikkei. It looks as though they're doing their best to fend off the approach from Couche-Tard. Now, why that's interesting is it means they're actually worried that the deal might have been accepted. So they want to maintain control of what they see as their company, their legacy.
Yeah.
And they were obviously worried that, the board of directors, Seven & i has a majority independent board, which is a rarity in Japan. But generally, independent directors are not super independent. They're outside, but they're generally pretty tight with the company. But in this case, the founding family was obviously worried enough that this deal might get accepted that they've felt the need to go and put together their own bid for the company. So I think that really does indicate that Japan is open for business now, open for doing deals.
Yeah, absolutely. And I suppose, moving on to valuation, right? So there's something cheap that you could probably, and with so much cash, that there's many opportunities for a foreign buyer to lever up and buy these things, right? Is that fair? You're not buying things that are too stretched in valuation. And so you would expect, more and more of this. Is that the right way to think about it?
I think so, yeah. So, I mean, at a high level, if you look at high level metrics, about half of the companies listed on the stock exchange in Japan trade below book value. Now, there's often very good reasons for why they trade below book value. But those reasons don't necessarily apply if someone else can get full control and run the company in a more capital efficient and operationally efficient manner.
Yeah.
So of the, half the companies trade below book value. Book value tends to be understated because assets are held at historical cost.
Yeah.
And there's about 500 or so companies that have cash on balance sheet worth more than half their market cap, net cash worth more than half their market cap. Yeah. So, I mean, it's a big market. There's 4,000 or so listed companies. But the market cap is an eighth, which is the same as the US, but the market cap is about an eighth the size of the US. So we're talking, thousands of small companies.
Yeah.
And so with our fund, what we're doing, we've identified a number of targets that have real estate and cash and investment securities worth more than twice their market cap, and they have nice, profitable core businesses. So there's this incredible valuation opportunity.
There's an incredible valuation opportunity. So I think this is a good opportunity to start talking a bit more about strategy and what you're hoping to achieve over the next few years. So if you don't mind, tell us the name, what your focus is, if that's okay.
Yeah, so we've founded Senjin Capital. I say we, it's myself and my business partner, Toby Umezaki. So Toby was previously with Taiyo Pacific Partners, a long-time Japan-friendly engagement fund. So they don't do anything public, and I think he has seen the opportunity to take a friendly, constructive approach to companies. But if a company won't play ball, then you need some consequences for that, other than just selling your investment. And so what we want to do is take a friendly, constructive approach to engaging with companies. We want to help them increase their value, their corporate value. And that's suggesting things like, the low-hanging fruit is optimizing the balance sheet. But then it's also, should you be doing a lot of M&A? Could you be a consolidator of the sector? Can you deploy your cash reserves in a more effective manner and actually consolidate your market space? And oftentimes, M&A can be done quite efficiently and effectively in Japan. Have you integrated various aspects of your operations well? Have you adopted digital technology to improve your business? A lot of times there's still a lot of manual processes in these companies operating on fax machines still. It's pretty incredible to think about. It sounds far-fetched, but it's true. And just helping companies with a level of financial sophistication. So my partner, Toby, likes to tell the story of presenting to a company's board of directors on returns on capital and optimizing the balance sheet. And he gets to the end of his 40-minute presentation, and the finance director, the CFO equivalent, he sort of says, excuse me, Umezaki-san, but what is EBITDA? Earnings before interest, tax, depreciation, and amortization. And the word for EBITDA in Japanese is EBITDA.
Yeah.
So it might sound a bit patronizing if I say there's a lack of financial sophistication, but literally for some of these companies, that is the level of sophistication where the CFO doesn't know what EBITDA is.
Yeah. I can imagine. So just on the consolidation part, we'll get to M&A in a minute. I think what people don't realize is just how competitive some of the domestic industries are. There's a lot of competition, fragmented, especially compared to the US, which has tended to, from the 1980s, consolidate whatever it might be, hotels, other sort of industries. Could you speak to that a little bit, and explain, pick a sector which you think there might be some opportunity in terms of consolidation?
Yeah, there's been a historical aversion to M&A in Japan. Like if you're selling your company, it's like you've failed. And because management has not traditionally been incentivized with equity upside, they don't see the gain from selling their company. So industries haven't consolidated, and because a lot of the big companies have their fingers in a ton of different pies, but they don't want to restructure their portfolio and make hard decisions, you have these crazy outcomes. So I think globally there are three major elevator manufacturers in the West. You've got Schindler, Otis, and I forget the third off the top of my head. But in Japan, you've got four in Japan alone: Fujitec, Mitsubishi Electric, Toshiba, and Hitachi. Like that just doesn't make sense. So it makes Japan this hyper competitive market for elevators, and so all the Japanese companies make their money outside of Japan. But that said, that market may consolidate soon because you've had an activist replace the board of Fujitec, and that company is looking to sell itself currently, which was announced. I mean, that's one area. IT services is this hugely fragmented industry in Japan. But now close to 20% of all the M&A deals done in Japan are in IT services. So it is consolidating. It is happening. But so many industries are just fragmented. People cut each other's lunch. They're worried about losing market share, so they won't raise prices because they think their competitors will just undercut them to try and take share. So you often see in the West, often the market leader will raise prices first, and then if the competitor doesn't follow, then they will punish that competitor. They'll cut prices, and everyone realizes eventually that it's a zero-sum game. So people just tend to follow the price increase and maintain the profit pool to a large extent. In Japan, that just hasn't happened, partly because the leaders aren't willing to take the risk that maybe they will lose market share.
Yeah, and I suppose just on that point about business owners or management not willing to take a risk, generally they haven't been incentivized to take risk necessarily over the last 30, 40 years. That is changing as well. You're seeing more, stock options and that kind of thing in Japan these days.
You are. It's still small, but particularly at the larger companies, you're seeing a greater portion of management compensation at risk. A lot, the stock option packages are tiny compared to the US and small even compared to, Australia. But it's moving in the right direction.
Yeah, it's interesting. Sorry, go ahead.
So the current management teams, the senior executives, a lot of them are almost see themselves as just caretakers, as stewards for the next generation. They want to maintain the company. They like their perks. They like being seen as, a senior executive of a listed company. They're not really interested in taking any risk and growing or in doing, something new, exciting, innovative where they might fail, because the worst thing you can do in Japan in this corporate culture is fail. So while in the West, taking risk is seen as being a good thing, and if you don't do anything, you're probably going to lose your job. In Japan, you're not going to lose your job unless you fail at something, unless you make a mistake. So it's kind of this weird inverted risk culture where you just are not, there's only downside to you trying something new and taking a risk. Yeah,
so I've had this discussion recently. In the US, the incentives I think are actually extreme now for some management at some companies, particularly the tech ones. So Japan, just if they change a little bit, it will have a massively positive impact, hopefully, with the incentive structure for management. there's a long, long way to go to replicate anything near the US in terms of how people get paid. But it's quite encouraging to see that, at least at the board level, it seems to be suggested more and more. Is that fair?
Yeah. I mean, you could maybe say the US is too far one way. But Japan is so far the other way that I think there is a lot of scope for improvement. I think really I think when we see the culture change is not necessarily about much bigger incentives for current management. It's more the next generation that's coming through. So we were in, and then the generation after that as well. So we just got back. I actually just got back from Japan yesterday morning. And while we were over there, I learned a new term, which is JTC, or as the Japanese would say it, JTC. And JTC stands for Japanese Traditional Company. So the graduates now are very much discerning between, okay, is this a Japanese traditional company where I'm going to be expected to work lots of overtime? They might post me to the other side of the world and I don't get a say in it, regardless of whether I have children at home. The decisions take a really long time to make. Is the company not really exciting and growing? Those are all JTCs. And nowadays, a lot of people are looking more for work-life balance. They want to live where they want to live, and they don't want to just be moved randomly at very little notice. And they want to be involved in their kids' lives. So the traditional salaryman culture was you dedicate your life to the company in exchange for a stable job, stable employment, and the knowledge that you'll move up in lockstep with your peers. That's changing. People don't want that so much anymore. They want to do more exciting things. They want to have work-life balance. They want to have some flexibility.
And
so
also
graduates are really starting to look at alternatives.
And also pay, right? So one of the things that might not be clear to everyone is just what's been happening on the wage front in Japan over the last few years, and how that's actually a very positive dynamic, because expectations improve and people have more money in their pocket and they spend more money. It's really been interesting to see that wage growth. Obviously, when I lived there, wages were always so low for Japanese workers, salarymen. But the knock-on effect now should be positive for consumption as well, right? Is that how you're looking at it? And obviously, young people naturally now have a bit more joie de vivre. They want to live, they want to earn some money. This is a massive positive step forward. Could you speak to that a little bit? I know it's not necessarily company specific.
Yeah, I mean, we've seen real wages decline in Japan. Nominal wages decline in Japan for like 30 years. And it's only recently that we've really started to see nominal wage growth. But that's partly been driven by just the cost of living inflation, with the yen collapsing from, it was about 105 to the US dollar, maybe 2.5 years ago. And it's gone out to high 150s. It's got as low as into the 160s. So Japan imports a lot of food, a lot of materials, like its resources, its energy. So the cost of living really did skyrocket. The cost of bill has gone up, as it has everywhere. The workers have thus had pay rises come through, but in real terms, they're still behind. But what we're seeing now is inflation has started to fall, so has come back into a kind of a reasonable level. The government wants some inflation, around that 2% mark, and wages are still growing. So because the labor market is so tight, because you just haven't had many children born in the last 2 decades. So graduates are able to be more selective about where they go. Companies, the vast majority of HR people surveyed at companies say that they have not been able to find the quality of talent that they want at the wages they've been willing to offer. So you do have this setup where wages can grow and the standard of living can increase for that next generation. But like, it's just to put this into context, with the yen where it is now, the starting salary for an engineer, like a software engineer out of university, is somewhere between 2,300 and 2,700 Australian dollars a month, depending on the company. So
try hiring someone at that rate in Double Bay.
Yeah, less than $30,000 a year. I mean, I started my first job out of university was at Deloitte in New Zealand, and I started on 40,000 plus a $3,000 sign-on bonus. So they're earning, a software engineer now is earning less than I was at Deloitte 20 years ago.
Yeah, so lots of room to perhaps see wage improvements, and obviously the knock-on effect would be consumption. So just going back to the company-specific stuff, M&A. So traditionally, I suppose it's a legacy of the 1980s. Japan bought a lot of stuff that didn't make sense overseas, right?
Yeah.
And
golf courses, trophy
golf
buildings.
courses, some company stuff they did on the M&A front. Now, fast forward to probably the 2010s, it would seem that Japan has been quite successful in many ways on the M&A front internationally, right? So I suppose Indeed is one with Recruit, Seven and I with what was the company in the States, Speedway?
A few acquisitions they've made in the States.
Yeah, and the home builders, which I'm very positive about. I tell everyone about the home builders, but essentially they've done some great acquisitions in the southeast of the States. I mean, they seem to be kicking some goals. Obviously, people recently saw the Nippon Steel, US Steel news. What was your take on that? Do you think it made sense as an M&A transaction when you were looking at it, or?
Look, it's not one that I've looked at closely. So I don't have any great insights into that. I'm more familiar with some of the companies on the consumer side, like Asahi Group. So
Asahi's a great one.
Really interesting. Yeah, they've pursued some really interesting deals, which at the time I thought they were maybe overpaying. So the first big deal they did outside was Independent Liquor, which I think they did overpay on, and they kind of got taken advantage of potentially by Pacific Equity Partners here in Australia, where and they actually won a settlement in court from Pacific Equity Partners over that deal.
Yeah,
because there had been some undeclared rebates paid to buyers of the company's products in order to pump up the volumes to make the company look more profitable than it was. But then they bought a couple of assets in Europe where AB InBev had bought SAB Miller and was selling off some of the European operations. And so they bought first Peroni and Grolsch, and then they bought the Eastern European businesses, Czech Republic, Poland, Hungary. And I thought they were overpaying for those acquisitions. They're paying 15 times EBITDA, but it was all funded with very low cost debt in Japan. Yeah. And they've actually run them. They've been run very well by the management that they've kept in place. And then more recently, another AB InBev deal, they bought Carlton United Breweries in Australia, and that's been a very successful acquisition as well. So that business has gone from being very focused on a declining Japanese beer market to having very interesting premium brands globally and great footholds in a ton of markets around the world. And I think maybe 70% now, at least maybe 60%, 70% of their earnings come from outside Japan. So I mean, I think the acquisitions have been a lot more strategic and a lot more sensible over the last decade than they were previously.
Yeah, that's generally my impression. And just in terms of the banks, I guess they can, if you're doing these transactions, the Japanese banks have tons of capital to lend, right? So, that's one big advantage for them, the Japanese.
Well, I mean, so if you're familiar with the Australian banks, you know that there's always a shortage of deposits relative to loans. The loan deposit ratio is negative, and the banks have to borrow offshore essentially to fund their lending. In Japan, it's completely the opposite. So the banks all have far more deposits than they have loans, and there's a lack of loan demand. So the banks are trying to grow in areas where they can see that loan demand created, and outbound M&A is one of those, but also leverage buyouts in Japan are becoming a big business for the banks. the private equity firms are all flooding into Japan because they see this great opportunity with the opening of the M&A market. And Japan's been an extremely profitable market for the private equity groups. So there was the Nikkei does this thing where they publish, they essentially offer to ghostwrite a partial autobiography for famous people that they think their readers might be interested in. So they did it for the previous governor of the Bank of Japan, and recently they did it for Henry Kravis, the founder of KKR.
Yeah.
So they had a 30-part series, basically publishing his memoirs. And in one of those articles, Henry Kravis says, if he was 30, well, he actually said, my co-founder, George Roberts, likes to say that if he was 30 and spoke Japanese, he would be moving to Japan today. And he said, I tend to agree with him. So basically, you got the co-founders of KKR saying that if they were 30, they would want to be in Japan. Because I think to them, Japan now looks a lot like what the US looked like in the late 70s, early 80s, where there's just so much opportunity for private equity and for just improvement in shareholder value at a lot of these companies via balance sheet and operational restructuring.
Yeah, and obviously a lot of KKR's early success was getting the leverage, right? So, they would massively lever up to buy stuff. And one would assume that that's possible in Japan now, like the banks will lend. So it's perfect. One would imagine that's a very good environment to be involved. So getting back to your fund, that's why we're here. We'd like to talk more about you. Where are you fishing? Are you in the smaller end of town, or what's your sort of focus, and what, could you give me some more details on that, please?
Yeah, we're starting at the smaller end of town because that's where just the absolutely outlandish opportunities are available. Bigger end of town tends to have more eyes on it, and they tend to be more advanced along their corporate governance reform process. So what we're looking for are companies that are very overcapitalized, undermanaged, and also preferably with some potential for bolt-on M&A. That's kind of our prime target area. Yeah. In our screening process, we're optimizing for avoiding grenades, obviously, but partly we want companies that have a reasonably open shareholder register, so the cross shareholdings aren't too great. Yeah. And when I say avoiding grenades, one of the things we screen out is any company that has takeover defenses in place, a poison pill in place. So we've seen the number of poison pills in Japan just go down every year. They've become very unpopular. It's now much harder to put one in place. The courts have said you need a shareholder vote to put a poison pill in place, and there needs to be like some detriment to shareholders to be allowed to have one. Yeah. But if the company already has one established, then that's probably not a target for us. And so as I said before, we're finding companies that have assets worth more than twice their market cap, like non-operating assets or operating assets that could be a lease rather than owned, but also very profitable and nice core businesses. We want businesses with stable cash flows that have barriers to entry, reasonably sticky customers, all those things that you look for if you're following that Buffett-esque type quality investment approach. And then optionality for growth via M&A. Because most of these companies are domestic focused. They're not particularly growing a lot. There's some exceptions, and those we like as well. But growth via M&A can be quite a reasonable strategy, particularly when you can acquire very cheaply and debt is very cheap to actually affect the acquisitions.
And Jamie, could you just, the opportunities exist because it's still a largely undercovered market. That's the bizarre thing. I suppose the sell side cover, maybe, I don't know how many stocks, maybe 800
maybe stocks? A quarter of the market.
Oh, maybe more.
Sell side cover.
Yeah.
Yeah, maybe. And then there's a little bit more coverage in the small cap area with some domestic brokers, but even for a company that, say, actually the biggest position I had when I was running Platinum's Japan strategies was a company that had a market cap of about $2 to $3 billion, depending on when you were looking at it. And that company was covered by one or no sell-side brokers, and none of the bulge bracket brokers covered it.
Yeah.
So, and once you get down to the smaller area, there's literally zero coverage. So you really have to do your own research, reach out to the companies yourselves, engage with them, speak to their customers and employees. We use expert networks as well to speak with people in the industry to get a full view. So sometimes customers, suppliers, competitors, to help us really like round out that 360-degree view of the company.
Yeah. That's really interesting. And so, you make an investment, you engage with the company, and to drive value, that's the main focus of the strategy.
Yeah. So we want to just point out the obvious things that the company can do to improve shareholder value.
Yeah.
Now, management may listen to us. They may not. And if they don't, then there are things that we can do to encourage them to take more action. So I said before, you can file a shareholder proposal at an AGM. You can seek to have outside directors appointed. It's a tough road, but that is appointing outside directors. But it is one that has been successful for a number of funds that have taken that approach. So in case of Fujisoft, which is now selling itself to KKR, they had an activist involved. Activist got some independent directors appointed. In case of Fujitech, the activist there was able to change the board of directors entirely. And also in the case of Toyo Construction, we're actually the founding family of Nintendo. They have their own family office. They managed to replace the entire board of directors in that case because the board of directors failed to consider a superior takeover offer after they'd agreed a friendly deal.
Yeah.
Now, so part of the conversation that we have with companies is, do you really need to be public? There's all these private equity firms in Japan now that have too much money and not enough deals because historically companies haven't wanted to sell themselves. There's just not that much deal flow for the private equity firms.
Yeah.
And they want to deploy capital. So they're looking for these deals constantly. So, there's the opportunity for us to introduce companies to private equity firms. The private equity firms will often offer management significant equity upside in the value creation that happens post deal. So I've heard of PE firms giving as much as 20% of the company to management, and to be shared, into the lower rungs of management as well, post deal. So that can be life-changing for some of these managers who aren't really paid that much.
There's a big economic incentive. And also, I guess, Jamie, being listed now is kind of a pain in the butt for some.
It can be.
It's becoming a problem. And so there's an incentive maybe to consider an alternative approach, right?
Yeah, so there's been this symbiosis between shareholder activists and private equity firms. So that kind of exists in every market, but in Japan, it's particularly pronounced. So, the Fujisoft deal that's been in the headlines recently, that's a result of an activist basically pushing the company to sell. The Fujitech situation, there was an activist that changed the board, and now the company's in discussions to sell itself. And a lot of management teams just get sick of dealing with annoying shareholders who now are demanding results. And they say, hold on, we can just go private. We won't have to deal with these annoying shareholders. We'll have one shareholder and we get to participate massively in the upside. That could make good sense for us. So part of what we want to do is educate management teams on that option. And I think there's a real symbiosis there where if you take a large position in a company and things aren't changing, maybe you can push them to sell the company and exit it.
And I suppose just generationally or age-wise, a lot of these owners of these businesses, if it's a founder-led listed company, they're getting on, right? They're sort of maybe 60s, right? So they are thinking about exits, and as is always the case, the kids don't necessarily want the business, right? That so there's always these succession. It happens in the States. At least when I was there, I saw a lot of these things where the kids didn't want the cash flow from the business. They wanted to actually just get one big hit. So that dynamic exists in Japan as well, right? So that's another reason why people might be incentivized to think about new approaches. Is that fair?
Yeah, that's been a key driver of the growth in M&A in Japan. And so a lot of the take private deals that private equity have done is literally buying out the founder who doesn't have an heir. And those are all friendly deals. And in the private markets as well, you've just seen a rapid uptick in M&A because these founders are getting into their 70s, 80s, and they don't have people that want to take over the business.
Yeah. So
There's
Jamie,
a huge number of businesses that need to sell because they have succession issues over the next 10 years.
So there's obviously a lot of opportunity in Japan, and you have a strategy that's focused on driving this value in these companies. So how does someone get in touch with you, Jamie?
I'm on LinkedIn and post quite a lot of content on there about the Japan opportunity and about what we're looking to do. Also on x.com or Twitter. My DMs on both those platforms are open, or someone can reach out to, if they follow you, Martine, they can reach out to you, and you can pass on my email address. I'm based in Sydney as well, so can meet with investors in Australia quite easily. So we're opening a Australian unit trust for wholesale investors in Australia. And we think what we have is unique in that there are very few Japan-focused funds in Australia at all. And I'm not aware of an activist strategy that has its own Australian unit trust, which is the structure that Australian investors will be familiar with.
Thank you. That's great, Jamie. So I do appreciate your time today. Japan has been part of my life since I was about 18. So this has been great to talk about a market in a country that I know reasonably well and it's dear to my heart. So thank you very much, Jamie, for your time, and hopefully we'll have further conversations going forward. Thank you.
Thanks for having me on, Martine. I hope so too.
Cheers. Thank you. Bye-bye.